Welcome to Smart Crypto Guides. In this video, I'll explain the basics of cryptocurrency in a few easy steps. That's right, I'll assume you're an absolute beginner with no technical knowledge of cryptocurrency whatsoever. Let's dive in. The evolution of money. Since the beginning of time, humans have relied on things to survive. Whether it's food, water, or shelter, we always find ways to make things easier for ourselves using tools, exchange of goods, and other inventions, like the light bulb or the wheel. Evolutions run through our DNA, from hunter-gatherers to farmers and office workers, from Silk Road traders to factory workers to online shopping. Over history, as we humans evolved, so did our money. Throughout the centuries, we've witnessed the evolution of money, from gold and silver to paper notes. You're probably very familiar with paper bills and physical coins. For the longest part of our living memory, most people bought things and still buy things in physical paper money. On the other hand, some people have shifted away from paper money. These people rely more and more on digital forms of payment, whether it's paying with your credit card, your phone, or your watch. But there's something special about paper money. Unlike gold and silver, intrinsically it has no value of its own. We can all agree that a piece of paper can be worth £10 or £100. But its value is based on what a government says it's worth. Since the beginning of paper money's history, central banks around the world have played an active role in managing many aspects of their country's economic system. I'll tell you more about this in a minute, but first, think of a central bank as a country's money managing department. They make the rules about how a country's money system works. Unlike traditional banks that lend you money to buy a home, central banks control many things about a country's money supply. But how does a central bank control the supply of money? It's easy. During good economic times, low unemployment rates, for example, central banks raise interest rates, which makes it more expensive for average people like us to borrow money. When interest rates rise, our banks make more money, but average people lose money. This is because the interest payments of all of our debt will increase. In return, and to cut costs, people will borrow less money and spend less money. Shopkeepers get antsy about products collecting dust on shelves, so they lower the prices, tempting people to come and buy more things. If people don't start spending money soon, we're left with deflation, or lower prices. During bad economic times, central banks lower interest rates. This makes it cheaper for average people to borrow money and spend money. When there's more money in everyone's hands, it can even happen that shops start running out of things to stock their shelves with. This is known as a supply shock. When supply shocks hit the market, prices start to increase. Markets may crash due to supply and demand shocks. When prices increase out of control, we're left with what's called inflation. Throughout the history of time, central banks have tinkered with the supply and demand of money. That's why we have market booms and busts, good times and bad. Things are never stable for too long. In the long run, prices continue to increase, spending power diminishes, and $1 in 2010 is not worth as much as it will be in 2030 due to annual inflation. Hopefully, you can see why it's not ideal to have a currency that's backed by a central bank. Any currency that can be controlled by a central entity is called centralized currency. So, what's the solution? Digital currencies like cryptocurrency are the solution. How? Don't humans control cryptocurrencies? First, It's important to understand that cryptocurrency is simply a form of digital currency. It's yet another step in the evolution of money, from gold to paper bills to digital money. Unlike paper bills, the supply and demand of cryptocurrencies are not controlled by a centralized entity like a central bank. Cryptocurrency is decentralized. This means cryptocurrencies are created using computer programs. In theory, anyone can create a coin. Transactions are monitored and recorded in an open and transparent way on what's called a digital ledger. You can imagine a digital ledger as digital notebooks. Those digital notebooks are called blockchains. Blockchains simply give users a whole bunch of information, like where to send money, how much to send, and what date money was sent. Think of blockchains as digital notebooks that store all transaction-related information. Blockchains are extremely safe. This is because information on the blockchain is decentralized and anonymous. Everyone can see and follow the transactions, but they can't change any information, making it hard for fraudsters to tinker with transaction records. More importantly, no personal information is stored on the blockchain. Cryptocurrency transactions are anonymous because of the nature of blockchains. No one will know that you sent your friend £20 on the blockchain. All information is encrypted, which is a fancy way of saying only people with private keys can access your message and money. Cryptocurrency can be a deflationary form of currency. There's one more thing to know about central banks. Remember the bad times? That's when they lowered interest rates and made it cheaper for people to borrow money. Where is all that money going to come from? It's simple. They print new money. Central banks create money out of thin air. That's bad for average savers like you and me. As more money is printed, there's more money floating around, devaluing the dollar and raising prices in return. Cryptocurrency like Bitcoin doesn't work this way. Nobody can create more than 21 million Bitcoins. Cryptocurrency can be programmed to have only a certain amount of coins in circulation forever. This means that as more people buy Bitcoin, its price will theoretically continue to rise, making us all richer in the process. Even if you want to buy a coin after its price has started increasing, you can still benefit from that. You can simply buy sections of a coin, and the money you invest will increase in value. What is cryptocurrency used for? Cryptocurrencies can be used for a wide variety of purposes, including as a store of value. But it can also be used to pay for real-world things. For example, you can buy a cup of coffee at Dunkin' Donuts with your Bitcoins, or you could pay for your new Lamborghini with Bitcoin as well. Well, if your pockets are deep enough, that is. Speaking of pockets, it's important to know how you can safely store your cryptocurrency. Think of the keys to your house. If you give a friend your key to your house, only your friend can access it. As long as you don't give your key to anyone else, only you can access what's in your house. The same idea works with cryptocurrency. You'll store your digital currency on what's called a digital wallet. It's very easy to get a cryptocurrency wallet. We'll cover this in a future video, but for now, the most important thing to keep in mind is never share your private key with anyone. The key takeaway in this video is that cryptocurrency is a digital currency. If you liked this video, subscribe to the channel and let us know what topics you would like us to cover.